In today's webinar, we'll look at some of the widely used methodologies for valuing stocks. But before we do that, let us quickly recap what we did in our previous webinar. In the previous webinar, we looked at what is known as value creation. This is a term very frequently used by company managements, the analyst community, media like CNBC, and just about everyone in the investment industry. So, what is value? Um, one definition is that value is something that has an inherent worth. If something does not have value, it may as well be junk. And so, why should we possess it? Um, Mind you, it need not only be in terms of physical, financial, etc. Value can also be emotional, something that is close to your heart. But in investing and in finance, value is something that an asset is worth to us. So now, as a shareholder of a company, we know that we own a part of the company. So we expect that the management will work towards the goal of increasing the value of shares held by us, and that is what is measurable. So what can a company do to enhance shareholder value? We saw in the previous webinar that there are five pillars of value creation that good managements use in order to increase shareholder value. These are growth, profitability, innovation, risk management, and corporate governance. We also saw that there are three primary drivers for value creation. There is revenue growth, which is brought about by sound capital allocation strategy. Then we have increasing ROIC, which is return on invested capital. And the third driver is increasing free cash flow to the firm. So we also saw that value is the true worth of the stock. And if value is the true worth of the stock, how do we reconcile it with the market price? So market price is the price that the stock is selling in the market. So in that context, we touched upon the efficient market hypothesis, which says that the market is the final arbiter of value of the stock, since market is the collection of all opinions and the information prevailing among all the participants in the market. And so there is not much extra, quote unquote, insights that can be unearthed. Adherents to these philosophies are passive investors, such as with vehicles such as index funds, index plus, and smart beta strategies, etc., which say that since you can't beat the market on a sustained basis, you might as well join or you might mimic it. And then on the other hand, we learned that there are investors who say there is a difference between the true intrinsic value of the stock and the price quoted in the market. These folks use active management philosophies, which say that the market is irrational. And there are times when fear, greed, and just plain old misreading of the future allows inefficiencies to creep in. And that results in the mispricing of stocks. But it is to be noted that this mispricing does not last for long, and the gap is quickly closed. And so active managers get in fast, take advantage of this mispricing, and buy the stock at a discount. So the tussle between active and passive investing is dynamic, and at certain times of the business cycle, one or the other finds favor with the investors. Of course, the reality of the situation is that more money is flowing into passive funds, probably because investors are wary of the risks in today's environment and want to play it safe by putting money in index funds. Then we touched upon the what is known as margin of safety. Now, margin of safety recommends that active managers look for those stocks which are not only undervalued but are at a sufficient discount to the market price so that there is a long enough runway for the stock to appreciate and make money for investors. Lastly, we looked at weighted average cost of capital. Now, what is weighted average cost of capital, or WACC? It is the discount factor or the discount rate which is applied to free cash flows of the firm over the holding period that brings future cash flows to present in order to calculate the intrinsic value of the firm. We saw that instead of taking just the cost of equity, we must also consider debt because the debt is part of the invested capital. And so, weighted average cost of capital becomes important. And um, what follows is that capital structure also plays a key role in the calculation of the value of the firm. So, now let us look at some of the valuation models. And since we know already the intrinsic value of the firm is calculated by the the summation of the present value of all the free cash flows occurring in the holding period. Okay, so now you can see, as you can see, there are three widely used valuation models. That is the dividend discount model, the multiples or comparable companies model, and the discounted cash flow model. Now, the DCF. DCF is probably the most widely used um, valuation model, but that is not to say that the other two models are not important or not used widely. For example, multiples or comparable companies model are used extensively in investment banking, especially to value firms which want to tap the public markets or to come for an IPO, because there is not much market data that is available for the firm. Investment bankers, in order to put a value on the firm, what they do is that they compare the potential IPO company with similar companies in the same industry, and so using the metrics, the comparable companies multiples, they try to value the firm. And so now let us today consider the dividend discount model. An easy and simple way to value the stock is the dividend discount model. It assumes that for a dividend paying stock, the cash flows are the dividend payments that the company makes to the shareholders. So, what are these future cash flows? One is the dividend payments that the company makes, and the other is the proceeds from the sale of the stock at the end of the holding period. So there are two types of cash flows. So the DDMs, or the dividend discount model's premise is that if we discount these cash flows to present and add them up, we will get the intrinsic value of the stock. But the $1 million question then becomes, what should we use as the discount rate or the discount factor? We will come to that later on. And so, what does the DDM tell us? It basically tells us two things. It allows us to develop a theoretical stock price from a projected stream of dividend cash flows and an estimated discount rate. And so another thing that it allows us to do is it estimates an expected or return, a required rate of return from a stream of dividend cash flows and the current market price. Of course, our analysis holds good only if the company pays dividends. But most companies, most mature companies, they do pay dividends. Typically, large cap companies, blue chip companies, especially in all industries, and then utilities, etc., they regularly pay dividends. On the other hand, small cap companies, startups, etc., they don't pay dividends, mostly because they show loss, and even if they make profit, they invest the cash back into the business, promising their shareholders higher total return in the future. So let us look at what the dividend discount model says in greater detail. So now let us look at the most simple scenario where you have a one period situation where you have P0 is the current price of the stock, P1 is the price of the stock at the end of this period, which can be 1 year, 1 month, but let's talk about it in terms of period. And so the cash flows occurring in this period are D1, which is the dividend paid in the period one, and the final cash flow that is occurring when we sell the stock at the end of period one. So, in the simple equation that we saw already, the price of the stock now, the intrinsic value of the stock now, is equal to the dividend payment discounted to the present, and the uh, P1, which is the proceeds of the sale at the end of the period brought to the present. Okay, so now let us look at the two period situation where we travel further in time, and now we position ourselves in at the beginning of period two. Okay, so now if we look at period two, then we see that by applying the same logic, we can find out that the price P1 equal to the same D2 discounted to P1 and P2 discounted to P1. Okay, so we have P1 equal to D2 divided by 1 plus K and P2 divided by 1 plus K. Now what we do is, here in this equation number one, we have P0, we have P1 here. Okay, so now we substitute this value of P1 into this equation. So if we do that, we get this. Okay, and finally, if we simplify this, we end up with this equation. Okay, so you can see the beginnings of a pattern where you have d1 divided by 1 plus k plus d2 divided by 1 plus k whole square, and then of course the terminal the proceeds of the sale of the stock. Okay, so now let us take this further to a three period scenario. So you have d1, d2, d3 are the dividend payments in period 1, 2, and 3, and similarly the prices of the stock at the end of each period. So now P0, what is P0? P0, we're repeating the previous slides information. P0 equal to D1 divided by 1 plus K, D2 divided by 1 plus K whole square, and P2 divided by 1 plus K whole square. So now P2 at this stage, P2 equal to, apply the same logic. P3, rather D3 divided by 1 plus K plus P3 divided by 1 plus K. Okay, same way we substitute the value of P2 in this equation. So if we do that and simplify, we get P0 equal to this. And you can see the pattern further continuing. We have D1 divided by 1 plus K, D2 divided by 1 plus K whole square, D3 divided by 1 plus K cube, and P3 divided by 1 plus K cube. So now as we go further and further, the effect of this P3, the price of the stock, becomes negligible. Okay, because so far out in the future, the value of the stock becomes very negligible. So we end up with this equation P0, and it is only in terms of the dividend D1, D2, D3, and then if we simplify this, this is basically a summation series, which is P0 equal to the sum of t equal to 1 to n is the number of periods, dt divided by 1 plus k to the power t. Okay, so this is a generic form of the dividend discount model. So know that this is the generic dividend discount model. Then the specific cases of the generic dividend discount model are as follows. So there are two specific cases. One is where the dividend grows on a constant basis. So that is the constant growth situation. So P0 equal to D1 divided by R minus G. So this is the equation that defines the constant growth situation where R is the required rate of return, D1 is the dividend paid in period 1, and G is the dividend growth rate. What you should understand in order for this to be valid is that R should always be greater than G. That is, the expected return should be greater than the dividend growth rate. And so when we talk about dividend growth rate, this is the basically growth equation where D1 equal to D0 times 1 plus G. And then we have the second specific case. For here we spoke about the constant growth situation. And here we are talking about a zero growth situation. So where the dividend does not grow at all, and companies just maintain the same dividend year after year. But however, cases like that are very rare, almost negligible. And so, but the price of the stock in this situation is P equal to D divided by R. So these are the two specific cases of the generic dividend discount model. Now we will look at some specific problem situations. Okay. So we look at now the dividend discount model, constant growth rate. So let's take another example. So this is where the you see the two periods. P0 is the current price of current intrinsic value. P0 is the current price of the stock, P1 and P2. Okay, so now from the dividend discount model, we know that D1 equal to D0 times 1 plus G. Okay, so D0 is the dividend just paid, G is the dividend growth rate, and R is the required rate of return. So similarly, for a two-period situation as given here, D2. What is D2? D2 equal to D1 times 1 plus G, because D1 grows at the rate of G. Okay, so D2 equal to D0, D2 equal to D1 times 1 plus G, which can be written in the form of D0 multiplied by 1 plus G whole square. Okay, so generalizing this, we get dt equal to d0 times 1 plus g to the power t, where t is the time period. And so for many firms, the growth in dividends is part of the dividend policy. So let us take an example. So ABC just paid a dividend of 10 rupees per share. So D0 is 10. And the dividend grows at the constant rate of 6% per year. So G equal to 6%. Based on this information, what will be the dividend in 5 years? So T equal to 5. So it's very easy. Dt equal to D0 times. So D0 is 10 and G is 6 and T equal to 5. So you just plug in the numbers in this equation. So we get dividend paid in the 5th year is 13.38. Okay. So now, as we have already seen, these are the equations governing the constant growth rate dividend discount model. So now let's take another example. We look at a 5-period scenario, okay, where D1, so D1 equal to 4, the rate of return R equal to 16, and the dividend growth rate is 6%. So now what is it? What they've asked for is what is the value of the stock now? Okay, so what is P0 and what is the value of the stock at the end of the 4th year? That is P4. This is what they are asking for. So now easily we can find out what is the value of the stock now, which is D1 divided by R minus G, which is we just plug in the numbers and we get P0 equal to 40. Now what we have found out is P0 equal to 40, the dividend growth rate is 6, and the required rate of return is 60. So now the second part of the question is what is P4? Okay, so now let us see dt equal to d0 times 1 plus g to the power t and d1 equal to d0 times 1 plus g. So we find out what is D5. Why D5? So if we want to find out the value of P4, then what we do is we discount this D5 to present. Okay, so now D5 equal to D0 times 1 plus G to the power 5. Okay, so that is the same as we write this in terms of D1. So D1 times 1 plus G to the power 4. So just plug in the numbers, we get 5.05. Okay, so and then from the dividend discount model equation, we find that PT equal to dt plus 1 divided by r minus g. Okay, and then so plug in the numbers again, so you get P4 equal to 50.5. So quite easy. In a constant growth rate, you can find out what is the current price of the stock as well as the price of the stock at any point in future. This is given what? Given the cash flows as well as the expected rate of return. Remember the two things that we said that we can derive out of the dividend discount model. One is the price of the stock given the cash flows and the expected rate of return. What is important is now let us calculate the required rate of return. And this is interesting. Now we know that P0 equal to D1 divided by R minus G. And so this is the diagram that exemplifies that. So rearranging this equation, we get R equal to D1 divided by P0 plus G. So now what is D1 divided by P0? D1 is the dividend and P0 is the price of the stock. Okay, and so this is the dividend yield and G is the dividend growth rate. So now you must remember that there is a particular theorem is that if cash flows of an investment grow at a constant rate, the value of the investment also grows at the same rate. So here what we can take is that this is the value, this is the capital gains yield. G we can consider as the capital gains yield. So the return has two components. One is the dividend yield and the other is the price appreciation or the capital gains yield. So that's the thing that we have to remember. So here for P0 equal to 20, D1 equal to 1, G equal to 10% and T equal to 1. Okay, so if we plug in the numbers here, P1. So P1 equal to P0 times 1 plus G to the power 1. Okay, so it's a one period scenario and we get P1 equal to 22. So P0 was 20 and P1 is 22. Okay, so this is what it is. So here P0 is 20 and P1 is 22. Now, what are the cash flows that are available? One is the dividend in this period, and then the price appreciation. That is, if we sell the stock at P1, then we will get 22 rupees. So how much has the stock appreciated? The stock has grown by 2 rupees here. So the stock has grown by 2 rupees. And so in terms of percentage, 2 divided by 20 is 10%. Okay. And then what is the dividend that we have got? We got dividend of 1 rupee. Okay. So 1 divided by 20 is 5%. So to capital gain yield is 10% and the dividend yield is 5%. Okay. So the total return is the sum of these two, 10 plus 5 equal to 15%. So in this example, we have a stream of cash flows and then we have the price of the stock, and so that we can find out the total return of the stock in one period. Okay, and so another thing to remember is that the total return consists of two components. One is the dividend yield and the other is the capital gains yield. So in this way, we can see, the dividend discount model is a simple and yet informative way of valuing a stock. So next, we will look at comparable companies model or the multiples model.